Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Waste Management was founded in Chicago in 1968 by Wayne Huizenga. Through relentless acquisition, it built the largest solid waste collection and disposal network across the United States and Canada.
The business collects garbage from residential neighborhoods, commercial properties, and industrial sites, then routes that waste through transfer stations and ultimately into its network of over 270 permitted landfills.
The landfill is the irreplaceable asset. Obtaining permits to site a new landfill near any populated area is effectively impossible due to community opposition and environmental regulation. Existing sites hold permanent, unchallenged local pricing power.
Route density economics compound that advantage. Once Waste Management dominates a geography, adding one more pickup stop on an existing route costs almost nothing. Incremental revenue lands at extremely high margins.
Collection is the largest segment at about 60% of revenue. Disposal adds another 25% through tipping fees at transfer stations and landfills. Recycling and other environmental services round out the remaining mix.
Landfill gas-to-energy is a quietly powerful business. Decomposing organic waste generates methane. Waste Management captures that gas and converts it into renewable natural gas or electricity sold to the grid.
EBITDA margins around 30% are exceptional for what looks like a simple trash collection business. The financial quality reflects the combination of regulated landfill scarcity, pricing discipline, and route density leverage.
Yield growth, the annual pricing increase on existing contracts, runs around 5 to 6% consistently. This is a regulated utility-like pricing mechanism built into long-term municipal and commercial collection agreements.
On the competitive radar, Waste Management and Republic Services are the dominant U.S. duopoly in solid waste. Both benefit from the same landfill permit scarcity, but Waste Management's scale provides incremental advantages in technology investment.
Jim Fish has been CEO since 2016. His tenure has focused on technology modernization, automated collection trucks, digital customer platforms, and data analytics applied to route optimization, elevating operational efficiency across the network.
The 2023 Stericycle acquisition added regulated medical waste collection, a complementary, higher-margin business where disposal requirements are strict and switching costs are significant for healthcare providers.
Waste Management has raised its dividend for over 21 consecutive years. The yield around 1.4% is modest relative to the stock's appreciation, but the underlying payout growth has been reliable and compounding over time.
Serving over 20 million customers across the U.S. and Canada, Waste Management touches virtually every household and business in its service territories, a geographic breadth that makes it a proxy for North American economic activity.
The long-term investment thesis is simple. Trash is non-discretionary, landfills are irreplaceable, and pricing power is structural. That combination produces highly predictable free cash flow regardless of economic cycles.
That's the company chapter for Waste Management. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Waste Management just posted first quarter earnings per share of $1.81, beating the street's estimate of $1.75. That's a 3.4% beat in a business that most investors treat as completely predictable and unexciting. But boring and predictable is the entire value proposition here. WM runs the largest environmental services network in North America, and when you layer in their growing renewable natural gas operations and the recently completed Stericycle medical waste acquisition, you start to see a company that's quietly becoming more valuable than the garbage trucks on the label suggest. Revenue came in at $6.28 billion for the quarter, solid across every major segment. So why does that beat matter right now? Because pricing power in a mature, asset-heavy infrastructure business is extraordinarily hard to sustain, and Waste Management is sustaining it. That compounding story is what we're unpacking today.
Waste Management is the largest integrated environmental services company in North America, and that is not a close race. They collect solid waste from residential and commercial customers, run a dense network of transfer stations, own and operate landfills across the continent, and handle recycling. What makes WM structurally powerful is the physical network itself. You simply cannot replicate 250-plus landfills, thousands of collection routes, and hundreds of transfer stations from scratch. The regulatory barriers alone take decades and hundreds of millions of dollars to navigate. On top of that core franchise, WM has been building higher-margin adjacencies. Their renewable natural gas business captures methane that would otherwise be flared from landfills and converts it into pipeline-quality fuel, a genuinely valuable and growing commodity stream. And the 2023 acquisition of Stericycle added regulated medical waste disposal at scale, opening a new vertical with its own customer base and pricing dynamics entirely separate from municipal solid waste.
First quarter 2026 earnings: $1.81 actual versus $1.75 estimated, a 3.4% beat. Revenue was $6,279 million. That revenue number represents solid performance for a company operating in a market that simply does not have explosive unit volume growth. WM does not win by moving dramatically more trash from one place to another. They win by charging more per unit and running operations more efficiently than any competitor could realistically replicate. The EPS beat was driven by a combination of disciplined pricing execution, tight cost controls across the collection and disposal network, and the early contribution of Stericycle revenues being absorbed into consolidated results. Analysts had modeled a fairly conservative quarter given the ongoing integration costs, so clearing that bar with visible margin headroom was meaningful. The stock trades around $220, and the market has consistently rewarded this company's execution with a premium multiple over time.
Walking through the income statement, revenue of $6.28 billion reflects WM's pricing power working exactly as designed. Their collection business benefits from CPI plus contract structures, meaning they automatically pass through inflation to customers with an additional premium on top of the index. That is a structural pricing advantage most industrial companies would love to have, and very few actually do. Gross margins stay supported because landfill economics are largely fixed cost. Once you have a landfill permitted and operating, incremental tonnage flows in at nearly pure contribution margin. Operating expenses did tick up in the quarter with Stericycle integration costs baked in, which is expected and finite. It is a one-time drag that resolves as the businesses fully merge. The renewable natural gas segment continues to carry structurally higher margins than core collection because the capital was deployed in prior years and the revenue is now maturing. Net income growth year over year reflects both the revenue scaling and the early efficiency gains from consolidating Stericycle's operations onto WM's platform.
The signature metric to watch with waste management is yield. That is the revenue per unit pricing growth, excluding any changes in collection volume. WM targets core price improvement plus CPI-linked adjustments that consistently run above volume growth rates. In a mature solid waste market, where unit volumes grow at roughly the rate of GDP, call it 2 to 3% in a good year, the only reliable way to compound earnings is to keep yield above cost inflation. WM has done exactly that for years running. What is new in this cycle is the layering of renewable natural gas economics directly on top of the existing asset base. Landfill gas that used to be flared off or minimally captured is now generating real commodity revenue with long-term offtake agreements. As more of WM's facilities come online with full RNG infrastructure, you get a growing, high-margin income stream that is entirely separate from the competitive dynamics of waste collection itself. That RNG business is the hidden growth engine running inside a company the market thinks it already fully understands.
Cash flow is where WM's business model shines most clearly and consistently. The company generates substantial free cash flow because landfills have very long, useful asset lives measured in decades, And the collection fleet, while capital-intensive to maintain, follows a highly predictable replacement cycle that management can plan around years in advance. Operating cash flow in the quarter remained healthy and continues to support both the dividend and ongoing share repurchases without strain. The balance sheet does carry elevated debt from the Stericycle acquisition. That was an all-cash deal valued at roughly $7.2 billion, so net leverage is higher than WM's historical norms coming into 2026. However, management has communicated a clear and credible path to deleveraging over the next 2 to 3 years as Stericycle's cash flows integrate fully and the synergies that were modeled at deal signing begin to materialize in the P&L. The investment-grade credit rating remains firmly intact, which matters because WM's business depends on access to long-duration, low-cost capital for landfill permitting and infrastructure investment.
On capital returns, Waste Management pays a dividend currently yielding approximately 1.5% at prices around $220. That sounds modest relative to some infrastructure peers, but the dividend carries a long and unbroken track record of steady annual increases. WM is fundamentally a dividend growth story rather than a high current yield play. The buyback program continues, though management has moderated the pace post-Stericycle as deleveraging takes priority. Full year 2026 guidance from management reflects genuine confidence in continued pricing momentum, further margin improvement as integration costs taper, and incremental RNG revenue contributions from new facilities expected online through the year. They have signaled explicitly that once leverage returns to their target range, the capital return program will accelerate meaningfully again, both the buyback pace and the dividend growth rate. The combination of growing dividends and latent buyback capacity creates a shareholder return compounding machine.
Management's commentary on this quarter centered on 3 interconnected themes. First, the Stericycle integration is on track and running modestly ahead of the initial synergy timeline. That is a meaningful positive, given how closely the Street is watching integration execution. Second, the renewable natural gas business is growing as a revenue line, with several additional facilities expected to reach commercial operation through 2026, adding to the recurring high-margin revenue mix. Third, pricing momentum in core solid waste collection remains solid despite a somewhat softer macro backdrop for industrial activity broadly. CEO Jim Fish specifically emphasized that the company's CPI-linked pricing model continues to deliver real yield above inflation, even as some volume metrics remain measured. Near-term catalysts from here include announced data center waste and recycling service contracts. Hyperscalers building out AI infrastructure generate enormous commercial waste streams, and the potential for additional RNG conversions across WM's existing landfill footprint, each of which requires minimal new operating infrastructure.
Analyst sentiment on waste management sits firmly at buy consensus, with a price target in the range of $238 against the current stock price of roughly $220. That implies approximately 8% upside on price alone before you add the dividend, putting total return potential in the 9 to 10% range over 12 months. Respectable for an infrastructure holding. The sell-side bull thesis centers consistently on pricing power durability, the significant RNG optionality embedded in the existing landfill network, and the Stericycle synergy realization timeline. The more cautious voices in the analyst community acknowledge that WM currently trades at a meaningful premium to the broader industrial market. The valuation already prices in a lot of the good news on synergies and RNG. Several analysts moved to hold immediately after the Stericycle deal was announced, citing integration execution uncertainty. The Q1 beat helps rebuild confidence that management can absorb the acquisition without missing their core operational targets in the base business.
On valuation, Waste Management trades at roughly 30 times forward earnings at a stock price near $220. That is undeniably a premium multiple for an industrials company, but premium multiples in infrastructure are earned through the predictability of earnings, the durability of pricing power, and the near irreproducibility of physical assets. For context, regulated utilities trade at similar or even higher multiples despite having lower earnings growth potential. WM's earnings have compounded at mid to high single digits for years without major interruption, which justifies a premium to the broader industrial sector where earnings are far more cyclically exposed. Enterprise value to EBITDA sits around 17 to 18 times, again elevated versus commodity industrial names, but appropriate for a business with near-monopoly characteristics in its local geographic markets. The analyst consensus target of $238 implies modest but visible upside. The stock is never cheap. It never really has been. But the quality of earnings and the durability of the competitive moat justify the price of admission for long-term investors.
Bull case 1. The renewable natural gas business is materially undervalued in the current stock price, and that gap closes as more facilities reach commercial operation. WM has dozens of landfills that are eligible for RNG conversion across their network. As each facility comes online, it adds a high-margin, recurring revenue stream with meaningful government incentive tailwinds via renewable fuel standard credits that have real commodity value. Natural gas prices have been volatile quarter to quarter, but the long-term direction of policy, decarbonization mandates, tightening landfill emissions regulations, and government support for renewable energy production is structurally favorable to exactly what WM is building. If you model even modestly accelerated RNG facility rollout versus the base case, the incremental earnings per share contribution over the next 5 years is quite significant. This is the optionality that patient, long-term investors are holding through the premium valuation multiple. It is not speculative. It is a real, growing business being built inside a business the market thinks it already fully understands.
Bull case 2. Stericycle synergies exceed initial guidance, and the earnings accretion from the deal arrives ahead of schedule. Medical waste disposal operates under a different regulatory framework and serves a different customer base than municipal solid waste collection, but the operational DNA is remarkably similar. Logistics at scale, compliance management, asset-heavy infrastructure, and disciplined route economics. WM paid a full price for Stericycle, and the integration thesis depends on extracting meaningful cost synergies through collection route optimization, shared back-office and administrative functions, technology platform consolidation, and pricing normalization in medical waste markets that had fragmented and somewhat inconsistent competitive dynamics before the deal. If synergy realization runs ahead of the original schedule, and early commentary from management genuinely suggests it is, then the earnings accretion arrives earlier than the street modeled at deal announcement. In a premium multiple stock like WM, a positive estimate revision cycle driven by ahead-of-schedule synergies tends to drive meaningful price performance above and beyond the earnings improvement itself.
Bull case 3. Data center proliferation across North America is a genuine and growing demand tailwind for waste management's commercial collection business. The hyperscale infrastructure build-out driven by artificial intelligence investment is generating enormous volumes of commercial waste. Construction debris during facility build-out phases, electronic waste from equipment refresh cycles, and ongoing daily operational waste streams from massive 24/7 campuses. WM's commercial collection network, with its dense geographic coverage and long-standing relationships with property and facility managers, is extremely well positioned to capture those accounts at scale. The recycling business benefits additionally from the e-waste component of data center operations, which carries higher per-unit value than standard recycled material. As AI infrastructure spending continues to grow at a strong pace, WM captures an organic volume boost in high-margin commercial segments without needing to build any new infrastructure to serve it. Data center contracts are a small share of total revenue today, but growing faster than the core market.
Bear case 1. Landfill airspace capacity is genuinely finite, and then the regulatory and political environment around permitting new landfill capacity has never been more difficult. WM's long-term earnings growth depends in meaningful part on having permitted landfill airspace available to sell to customers over time. Permitting new landfill capacity in the United States is extraordinarily difficult in practice. Local communities consistently resist new facilities in their jurisdictions. Environmental review processes are lengthy and uncertain. Litigation risk is high. And the broader political climate around waste infrastructure has become more complex at every level of government. If WM cannot expand permitted capacity at existing facilities or successfully permit new sites at the pace needed to absorb long-term volume growth, they face airspace constraints that eventually create a ceiling on revenue growth, regardless of how strong their pricing power remains. This is not an immediate operational problem. WM has very long runway at its existing permitted facilities, but it is a structural ceiling that deserves weight when paying 30 times earnings for a company.
Bear case 2. The Stericycle integration carries real execution risk, and the acquisition was not cheap. WM paid approximately $7.2 billion in cash for Stericycle, taking on significant new debt to complete the transaction. Before the deal, Stericycle had a genuinely troubled operational history. They went through years of revenue declines, customer attrition, and management turnover before WM stepped in. The integration thesis requires WM to stabilize and then grow a business that had been shrinking, while simultaneously absorbing it into a very different organizational culture and operational system. Integration projects of this scale and complexity routinely encounter unexpected complications: incompatible IT systems, contract renegotiation friction with inherited customers, labor integration challenges, and regulatory compliance requirements across multiple medical waste jurisdictions that WM had no prior experience managing. If the integration takes meaningfully longer or costs materially more than management has projected, WM's leverage remains elevated longer than expected, the buyback stays constrained, and the earnings accretion timeline slides. The stock's premium valuation multiple is less forgiving of execution stumbles than a cheaper entry point would be.
Bottom line on Waste Management. This is a high-quality, durable franchise that earned its first quarter beat through exactly the mechanisms that long-term infrastructure investors pay a premium to own: disciplined pricing power running above inflation, operational efficiency, and incremental growth from higher-margin businesses grafted onto an already formidable asset base. The stock is not cheap at approximately 30 times forward earnings, and the Stericycle integration carries execution risk that the market will continue to monitor closely over the next several quarters. But the core business underneath that integration is as defensible as anything in the industrials universe: regulated assets, CPI-plus pricing contracts, and a physical landfill network that no realistic competitor is going to replicate. For investors who want compounding infrastructure exposure with growing renewable energy optionality and a steadily rising dividend, Waste Management fits that mandate about as well as anything currently available. The risk is multiple compression if integration stumbles. The reward is a business that quietly compounds through economic cycles regardless of what GDP is doing. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.